Good day. This is Sham Ganesh with Grow Your Wealth Financial Planning, and today I have with me a very special guest to speak about how to decide whether a particular investment that you make in your business is going to yield a good return. Like, how do you know if that investment is going to have a great return on investment? So my special guest is Laura Bechard. She is with Provision Business Consulting, right? Did I say that the name of the company right?
Provision Business Advisors.
Business Advisors. Well, she is a multi-talented individual. She has a CPA designation. She supports business owners in various advisory roles, including succession and exit planning. And so I'm really excited to have her join us on this call. So hey, Laura.
Good morning. Glad to join you again. Thanks for having me back on your program.
Yeah, wonderful. So kick us off. Like, tell us a little bit about what is what needs to be considered. Like, how does a business owner begin to think about how to go about figuring out whether when they want to make an investment in the business, whether that's a subscription to a new service, a marketing initiative, or some equipment, like what do we need to be thinking about?
Great question. And I think, people think about ROI, which is return on investment. So that's what, and it's also can stand for return on intention. And sometimes what do we intend to have that return on the investment is what we're tracking, right? So return on intention or return on investment, ROI. So when we are making that investment, we do have competing priorities. We have, oh, I could invest in a new team member. I could invest in a marketing initiative. I could invest in developing my team, or I could buy that piece of equipment that I've had my eye on for a while, or perhaps even make a down payment on a piece of real estate so that I own my own building rather than getting out of a rental situation. So we have all of these competing ideas of how to best use often limited amount of funds. We don't have the investment to do everything that we'd like to do. So it is a very common challenge. And so part of the work that we do with the clients that we work with is actually helping them figure out what I call the highest and best use of those funds. And so, we do need to do some forecasting around that. If we invested in a marketing initiative, for example, what is the return that we expect on that initiative? And is that the highest and best use of our funds? So we have to look at the options, and we have to look at, if we're investing in some longer term initiatives. So there's some initiatives, some investment in marketing being one of them. You say, well, I'm going to invest in quarter one. You expect to see a return on that investment before the end of the year. You may see it in quarter one, you might see it in quarter two, depending on what kind of marketing you do. There's often a lag to the investment of when you're going to see the return on the investment. And similarly, if you were to invest in a team member, as soon as you hire a team member, they're not as productive as you hope that they will be, because you've got to onboard them. You've got to train them a little bit. They've got to get used to the job, the company. But, the productivity that you expect from that team member is within sort of the first 3 months. You want them to be contributing more to the business than the investment in their salary and wages. So those kinds of investments, we expect to get a return on within the current year, and sometimes even within the next 3, 4, or 5 months, a very short term. But if we invest in equipment, we invest in real property, we invest in capital, we may look at a longer term return on that investment. And especially if we're looking at investing in systems or reorganization, we sometimes don't get the return on that investment until a second year or a third year. So as we're working with clients on building their business value, that's a really relevant question we have with them at the beginning to say, what is your timeline here to exit? Because if you're planning to exit this business within the next couple or 3 years, you're not going to get the return on any of the strategic investment unless you have a longer time horizon. So from a buyer's perspective, they're just going to see your profit going down because of these investments, because the revenue hasn't yet caught up to be able to get the return on that investment evident in your financials, which is what the potential buyer would be looking at. So long answer to a short question. Did that answer your question, Shan?
Yeah, that's fantastic. And as a follow-up, like how do you, that one of the criteria you mentioned to determine whether to make an investment or not is that understanding of a time horizon, whether that's because the business owner wants to exit, or maybe they want to, they're in it for the long haul. They're still, they know that there's lots of value to be created still, and they're wanting to grow. What are some other factors, like if as you said, there's these competing priorities between being able to make these longer term capital type investments in equipment or land or real estate, or even people, versus the shorter term, I just this additional tool would make me this much more efficient, like overnight. But how do you decide at what point do you do each one, and how do you know what metrics to track for each of those?
Yeah, great question. The metrics are going to be dependent on the type of investment. So we're often good at tracking lag indicators. So we're tracking things that show up on our financial statements. We're tracking the results, but we're not always really good at tracking the things leading up to the results, the activity that needs to lead up to those results. And so, if we're looking at a people metric, for example, where we may be looking at efficiency, we may be looking at their productivity rates, we may be looking at how is this person contributing to the company over time. And time on when we hire an employee, we're looking to have them spend a certain percentage of their time in different activities. So we're tracking those activities and the time spent in those activities to see, are we getting the return that we anticipated on that investment. So the metrics are going to be different depending on what that particular investment is. No one ever has a crystal ball about what are those returns. And one thing that we've certainly learned in 2020, 2021 is that we have to plan for the uncertainties. There are a number of uncertainties that come into the forecast that we generate for a business, and they are forecasts and they are plans. And so the plan will or will not come together based on a number of factors. And part of that is our ability to execute on the plan. But the other part are what's going on externally in our environment, whether it's political. We just had a budget in Alberta, so political decisions can impact our ability to execute on our plans. So can changes in technology, changes in consumer tastes and preferences can impact how good is our plan in terms of executing it for its delivery. So when we're looking at intended purchases, we're generally looking at efficiency and effectiveness, or we're looking at expansion. So is that investment going to allow us to expand into new markets, into new geographies, into serving more customers, or is the investment going to help us be more effective? So we're going to have less rework, we're going to have less waste, we're going to not have as much downtime, or is it going to be more efficient? Are we going to be able to do things faster than we're doing it another way, which might be why we might want to introduce an automated system, but it might also be why we just want to review our processes on a regular basis and cut out the stuff in there that isn't efficiently and isn't necessary to maintain the quality of the products or services that we're offering.
Nice. I like that. I really like that. Either, any investment is either going to improve efficiency or effectiveness, or it's going to help make that expansion. And how do you know whether it makes sense to borrow to make this investment? So a lot of times as a business is trying to grow, there's certain amount of cash on hand that's available, but also there are times when we need to go to the bank and get a loan in order to grow. And so what are the additional considerations, obviously, when financing one way or the other? because there's there's that additional cost of needing to pay that back when you are borrowing. So how do you really become certain that this something and a particular investment makes sense?
Well, excellent question. And on sometimes when I'm working with some clients that are on the smaller side that are maybe a first 2 or 3 years into their operation, they're often afraid of debt, and they say, I don't want to get any debt. I don't want to have a loan. They have some stories, either their own stories or stories of friends or family who have gotten into credit card debt in the past and problems with credit card debt. So they've just really got a mindset now that debt is bad. And so, a lot of some of the work that I do with them initially is educating them on making sure you've got the right debt for the right kind of investment. And most businesses cannot grow without becoming a friend with debt. The ability to use there isn't enough profit in many of our businesses that we can reinvest internally generated funds from our operations. There isn't usually enough. Profit margins are thin. And so if we're relying totally on organic and internally generated funds to fuel our growth, we're often grow very slowly and very painfully. And so to grow more efficiently and more effectively and faster, we often do need to be working with lenders. And whether that growth is by acquiring your competitor, if you want to go out and you can buy market share by buying out a competitor, buying a book of business, depending on what business you're in. You still need money to be able to purchase that book of business, and you rarely will have enough in your own personal assets. So lenders are critical in this role. And I recall when my husband and I were taking over the family farm, and it was all about building a line of credit and building credit limits. And I remember the one day, I looked at the credit card, and my husband had bought a truck and put it on the credit card. And I said, that's capital. Like, why are you putting the truck on the credit card? He says, well, we had the credit limit. I says, yeah, but we have to pay that now out of the line of credit, which now is, the interest rate on the line of credit versus I said, it's something like a truck. You can go and get a 7, you can get a term loan. You can get a 5-year loan, a 7-year loan, a 10-year loan on capital. And so, you need to match the timeline of your loan and your investment and your type of debt with the type of investment. So the bank is not going to loan you money to go and get fuel for the tractor. That's what you want to save your operating line of credit for. But the bank is going to lend you money for capital assets. So really, if you're purchasing anything tangible, you want to talk to the bank about financing it. Because usually we can get, and especially now with interest rates at a relatively low rates, we can finance something using debt better than using equity, when the equity being our retained earnings, our internally generated money. So it's often, you do have to factor in the cost of debt and the return on that investment. But interest is also tax deductible. So interest allows us to reduce our taxes, whereas the dividend or the equity payout is not tax deductible. That's in after-tax dollars. So we have to look at these options of not only what investment, but how do we finance the investment so that we're making the best decision for our company. And like I say, we don't grow anything, our personal wealth or our business wealth, without relying on other people. And those other people sometimes bring talent. They're our team members. Sometimes those other people give us money. And so sometimes they're investors, or sometimes they're our financial partners. And banks are really getting, the lingo, they're getting better at sort of positioning themselves as partners in a business setting, because very few businesses can effectively grow without having some sort of debt in their capital structure. So looking at your line of credit for things like financing your accounts receivable, like you're just waiting for clients to pay you, or you may be waiting, financing some inventory. Lots of times suppliers will finance inventory. You can get inventory from your suppliers and not pay for it until you've actually sold it. So you can often get some really good financing from your suppliers. And so your line of credit is sort of operational kinds of things, like being able to make sure that you can make your payroll, making sure that you can make your rent. Like So those are the kinds of things that we're looking at for financing on using a line of credit, and then looking for term loans or other loans to finance any of your tangible asset acquisitions or investments in real property or equipment or vehicles or computers or that sort of thing.
Where do new hires stand in that? Are they more in the first category where they are part of the working capital, the ongoing? They're not obviously like a piece of equipment that you amortize over 10 years. And is there a variance in like the type of role that a person would be coming into in the business? So for example, if you are looking to just have more output, like if it's a manufacturing company, you just need a few extra people to manufacture additional widgets, that would obviously be kind of on an expansion basis. Versus if it's a more strategic role that you're hiring for, is there a difference in how you would track the return on that investment?
Oh, absolutely. Anybody that you're hiring in, like we'd say, in the operational roles, whether those are on the line delivering, they're either part of your cost of goods sold, like their billable hours, or their labor going into the manufacturing of the widgets in your example. And so you're really looking for productivity there for those people that are on the tools or working and delivering the operations of the business. And you would be financing a lot of that through certainly through a line of credit if you needed to for the initial. And as again, sometimes it's a matter of what's in work in process. So what's all the inventory that we're holding, or the goods that are partly being manufactured, that we're having to finance that, because no employee is going to wait to get paid until you've actually sold the thing they manufactured for you. So we have to be able to finance that. And so depending on how good you are at managing your cash flow, what your receivable cycle is, your manufacturing cycle, your payable cycle, you may be able to manage your receivables with your payables, but you may also need to have a line of credit or some working capital to be able to finance that. When we're looking at hiring someone in a business support role, like I'd say somebody maybe that's doing finance work, or somebody's doing bookkeeping, or somebody in sales and marketing, or those business support functions, communication, businesses that are smaller in size, what we would call maybe Main Street businesses, often don't have the cash flow or the working capital that they can hire people to work solely for them. They might be able to find a part-time employee who would come in and do some bookkeeping for them, but they don't have enough volume of work to hire people full-time. And so to get the talent they need, they often will work with a firm that they can contract. So whether those are virtual marketing service, virtual chief marketing officer, virtual CFO services, virtual HR services. So you're getting fractional kinds of services, but you're getting the talent and the expertise you need. So it's often, yes, it's more expensive as an hourly rate to have that fractional CFO than to hire someone internally. But only when you look at it from an hourly rate, because why would you pay an exorbitant salary for someone to be sitting in when you're not effectively utilizing their talent?
Right, because there's two aspects to the investment. There's the cash flow side of things, how much you're paying for it, but also if you hire somebody where you're not the expert in finance, for example, but you need to train them, then you run into trouble. So paying someone an outside firm a higher hourly rate, but they're guiding you versus you're telling them what to do.
Yeah, well, and really astute business owners, they very quickly learn to check their ego at the door and hire the expertise they need. But by doing it yourself, you've actually got an incompetent person in the role. And why would you do that? Like, why would your time and energy, they say, well, it doesn't cost me anything, I donate my time. Your time and energy is better spent on the things that you are an expert in. And so whether that's the strategic direction of your business, whether that's improving your operations so that you're more efficient and effective, whether it's business development, but usually spending your time doing some lower, like the bookkeeping is another one. They said they hate bookkeeping, they never get it done, but they're doing their books.
They're still doing it on their own. Yeah. The question is, what's the hour, like what is, as a business owner, what's your hourly rate? Like what should you be doing $15 an hour tasks, $30 an hour tasks.
And it's the opportunity cost, which they often don't calculate. What's the opportunity cost? And say, well, because you're spending your time doing this function in your business that A, you're incompetent at, B, you don't like, C, you're not efficient at because you don't do it day in and day out. So you don't have any really good skills in this area. The opportunity cost is what you're not doing because you're choosing to spend that time. And sometimes that opportunity cost is just spending time with my family, spending time with my friends, spending time going to the gym and managing my stress, getting out to the mountains. So the opportunity cost could be the work-life balance that people say that they're always seeking, is that you're choosing to invest in those other activities in your business rather than that quality of life you're looking for.
And that opportunity cost really can be holding back the personal life, but also that like next level of growth, because how many times do we hear that, what's the next one thing you need to do to grow your business? And there's a certain, right away there's an idea. It's like, okay, why haven't you done that yet? Because I'm still doing my bookkeeping myself, right? Like,
depending on whatever we choose to use as our operation, or whatever our thing is, our craft or talent, we've got inputs that we're putting into a process, and the process is our business. So whether you're a service business, a manufacturing business, industrial supply, whatever your business is, that operational is your process. So you've got inputs coming into that process, and those are your investments. So your investments of people, your investments of money, your investments of capital, you're putting into this process. And the process of your operations, you anticipate or you expect there to be outputs at the other end. And so some people are measuring those outputs in terms of profits. Others are measuring them in terms of social good. Others are measuring them in terms of brand and recognition and value. So there's a lot of different ways that we can measure the output of the work. But the investments that we're putting in are going into that system. And so, the outputs of that system, in its very simplest forms, are your profit and the economic driver that you are in your community, for the jobs you created, the taxes you paid, the economic driver that your business is to your community.
Fantastic. Well, I think we can share a lot more in terms of examples and so on. Was there anything else in particular that comes to mind for you right now around this topic, Laura?
No, I love this topic because often we are working with business owners who forget to do the analysis before the investment. And we end up with the knee-jerk reaction to, I've got an idea and I'm going to implement the idea without actually thinking about, is this the best idea? Have I developed this idea enough? Is this idea robust enough? And part of that is the feasibility and the ROI on that idea. And we often get so excited about the ideas that we have, the things that we can do in our business, that we forget to take that step back to do some of the analysis. And that's really where people like our advisors come in, is helping you sort of step back and do the analysis, so that when you do make that investment, you've considered more of the risks associated with the investment. You've considered what is the ROI that you expect from that investment, and what are we then tracking to make sure that that return that we're expecting is actually realized.
Right, not to get carried away by the shiny penny or the thing that looks good but isn't really adding to the profit of the company. It's just a nice to have, and then we're basically wasting away some potentially really good dollars and time that can be put to use elsewhere.
And so many of our entrepreneurs are so passionate about the work they do and the people they help, and see that the solution for humanity and for the world. But if you haven't done that research part and talked to stakeholders and validated that the need that, as you see it, is actually the need that people will open their wallets to pay for it, whether those are funding agencies or whether those are customers, you can spend a lot of time and energy and investment in producing no ROI.
Mhm, mhm, mhm. Well, thank you very much, Laura. Really appreciate your time. For those of you who've joined us, thank you so much for joining us. If you do have any other business and cash flow related questions, please do feel free to comment or post below. We also have posted a questionnaire at the bottom of this video. If you do take a minute or two to fill that out, if you'd like to have a conversation with either one of us, then that will help us get the ball rolling, and we'd be happy to have a chat. So looking forward to getting to know you. Thanks again, Laura, and see you all on the next show.